Hi everyone, it's Jack back with another video. Today I'm going to be doing an analysis on Abbvie and whether it can keep up its famous dividend going forward. The company's had really good returns on the stock in the last year, up 32% despite wider market decline. Of course, the S&P has declined 20%, whereas Abbvie has gone really strong. Stock has declined 12% since its all-time highs in around March, with the main catalyst being earnings. I'm going to analyse those earnings, analyse its balance sheet and analyse the dividend as a whole, decide whether it's sustainable going forward. Not only has Abbvie been an excellent performer this year, but it has for many years. Since 2014, the stock price has roughly tripled, and in that time the dividend payout has gone up over 5 times, from around $1 to now $5.30. The dividend yield has flirted below 3, but it's typically well above 3, and at times has been over 5%, nearly 6% in 2019 when the stock price took a bit of a hit. Overall, this is not a company that is not overly reliant on its dividend because it's had excellent stock price returns, but as Humira revenues decline and other drugs don't seem to be taking over as quickly as they would like, it's likely that growth will decline slightly, stock price appreciation will decline slightly, and they'll be relying on that dividend for healthy returns going forward. The dividend yield as we speak is 3.52 on a trailing basis and 3.67% on a forward basis, far above the S&P 500 average for both a trailing and a forward, has a payout ratio of 76%, which is quite high. Not unsustainably high, but it is quite high, and it has grew at a 5-year average of 19.2%, which is absolutely excellent. Looking at the balance sheet, is this sustainable going forward? Well, the balance sheet is not great, but they've never really had a great balance sheet. The cash-to-debt ratio of 0.1 is not very good at all. Pretty weak for the pharma industry, which is an industry that is typically a high-debt industry. Many of them have high debt on the balance sheet. It's not very good for Abbvie's history, and that is basically due to some acquisitions not that long ago. They bought Allergan for a serious amount of money. I think it was something like $40 billion. So of course they took on some debt to manage this. That is not unreasonable, and it seems to be paying off, as we'll talk about in the report in a minute. Their interest coverage is 8.37, which means they can pay their interest with the current EBITDA for 8.37 years. With 1 year of EBITDA, which is excellent. I have no concerns about this. And although the Altman score indicates that this company is very close to distress with a given Altman score of 2, I don't believe that to be the case. I think this has a reasonably strong balance sheet and it has really good interest coverage. And again, this is not unheard of for the pharma industry. I think the way it's using this debt is quite sensible and creates lots of free cash flow. From a gross margin perspective and a profitability perspective, absolutely excellent. Nearly 70% gross margin, outstanding for the pharma industry, very near the top of the class, just generally really, really strong. That has been hurt recently, basically because of the introduction of biosimilars for Humira. Humira is such a large percentage of Abbvie's revenue, and the introduction of biosimilars mean they're getting hit on price a bit. That gross margins came down slightly. Still very, very strong. There isn't really much room to go. Like a 70% gross margin, that's come down from 75%. A 70% gross margin is still absolutely excellent. Operating margin of 34.5%, really, really strong. Very, very strong for the industry. And a net margin of 22%, meaning they take home 22 cents for every dollar of revenue. Really, really impressive numbers. And they don't stop there. Return on equity percentage of 86%, which is just absolutely ridiculous. One of the highest numbers you will see in any pharma company. Typically a much slower growth names, particularly for the mega cap size pharma companies over 100 billion. This is pretty much unheard of for them. Return on assets of 8.47%. It's a bit of an asset-heavy business, so that's not surprising that the return on assets is not ridiculous, but this is still probably in the middle of the range I would expect from this company, between 5 and 15% for a company of this scale and maturity. Return on invested capital, which is typically a very good indicator of long-term returns, 13.39%. Not very strong for Abbvie's history, but obviously it's a much larger company than it used to be, but still very, very strong. Having a look at those first quarter financial results, this is just some highlights. I'm going to go deeper into some of these revenues and how they've changed on a year-over-year basis in the next slide. But overall, net revenue of 13.538 billion, an increase of 4.1% on a reported basis and 5.4% operationally. Pretty good. Not insane, and you've got to remember the backdrop of Humira coming out of patent protection. These are pretty decent as far as I'm concerned for a company of this scale and maturity, and considering the global supply chain challenges that we have at the minute. Global net revenues for the immunology portfolio was 6.14 billion. This is the majority of the sales, an increase of 7% on a reported basis nearly, and 8.1% on an operational basis. US Humira net revenues not really increasing much, an increase of 2.2%. to 3.993 billion just for the quarter, which is really incredible how well this drug continues to sell. Internationally, where it's come under heavier pressure from biosimilars, net revenues were just 743 million, a decrease of 22.6% on a reported basis, which is quite a significant decline. Again, the citing biosimilar competition, which is fair enough. But the problem really is that Skyrizi and Rinvoq revenues are not catching up fast enough. These are both on a global basis rather than US on international as a whole basis. And while they were decent at $940 million and $465 million, they're just not catching up fast enough. From the hematologic oncology, sorry, it's a bit of a mouthful, they recorded 1.646 billion in revenue, a decrease of 1.6% again, which is not overly impressive. And this is due to a significant decline in Imbruvica net revenues of around 7%. From the neuroscience portfolio, an increase of 19%, and this is a relatively small section of the overall revenue at 1.5 or 1.448 billion. Very strong returns, up 19.2% on a reported basis, 20.4% on an operational basis. And global Botox therapeutic net revenues continue to be strong at 614 million. As far as aesthetics go, that was again increased 20% to now 1.374 billion. Very, very strong. And this is exactly what they need, these additions from Allergan, where they took on a lot of debt to make this acquisition to fuel the future growth of the business. They're growing at 20% on a yearly basis, and the more legacy products that they're needing to replace from within their own R&D are slowly falling out of fashion, and they're losing the revenues from that. So it's hoped that these newer products will be able to take over that revenue in time, but it just doesn't seem to be happening fast enough. Just diving a bit deeper into those revenues, I just want to look specifically at Skyrizi and Rinvoq, which are essentially the next generation Humira replacements. Both grew excellent numbers year over year, 63.7% growth for Skyrizi to 940 million, and Rinvoq 465 million, an increase of 53%. Again, both excellent year over year returns, don't get me wrong, but they're just not filling the hole of Humira fast enough. Humira is currently $4 billion, just shy of $4 billion just in the US, and global between them, not yet big, even half that, which is unimpressive. They really need to recover faster because they are losing Humira net revenues internationally very, very quickly. Of course, the Humira will not go to zero overnight. They will continue, they'll just change the pricing structure effectively. But there is going to be significant pressure on that in the future, and how much pressure we won't know. But there are biosimilar competition ready to be released in the US in the next few years. So it's kind of a wait and see job, but this level of uncertainty is not filling me with confidence, certainly. On a valuation basis, there's definitely a level of margin safety here. Forward P ratio of just 10.45 indicates that this is, well, it's trading far below the S&P 500 average, even though it's an extremely quality business that has returned multi-100% over the last 10 years. So this is really quite unfair and shows a significant degree of mispricing, in my opinion. 4P of 10 really just not pricing Abbvie's strong growth opportunities, excellent free cash flow generation, and strong dividend. PEG ratio of 1.5 indicates that, again, this is not absolute bargain territory by any means, but I would consider 1 to 2 to be thoroughly investable range. This is a really strong number for Abbvie's history and pretty good for the pharma industry as a whole. Price of free cash flow of 12, again, that's pretty cheap, but far below the S&P 500 average, indicates really strong free cash flows from this business, and they continue to have so. That should protect the dividend over the longer term. So is the stock good value now? Well, the only way to work this out really is to do a discounted cash flow. This is exactly the type of business you should be doing DCS for, in my opinion. Using a 5% growth stage rate, basically because I don't believe that 11% revenue growth over the next 10 years is completely sustainable as it currently stands. They're clearly not doing that at the minute with 5% in this quarter. I think 5% is a completely realistic, if not slightly conservative target. They have consistently performed well above that, and I have no doubt about that. I just prefer to go conservative on these metrics. They've grew free cash flow at 15.5% over the last 10 years, only achieving better over the last 5 and 1 year. But they did have an enormous cash cow in Humira, which how they're replacing that is completely uncertain at the minute, and they may come under intense pressure from biosimilars. I prefer to lean into closest to revenue, which was 11.5% over the last 10 years, and take a very conservative approach. 5%, I think that's fair enough. Even using this conservative approach and a 9% discount rate for the long-term returns of the stock market, this gave a fair value of $168, decent margin of safety, and about a 10% 10% premium over today's stock price of $151, indicating that this is undervalued based on this method. As far as net revenues are concerned, I think they could continue to grow revenue and therefore free cash flow and therefore the dividend from now until the end of time, basically, as long as they continue to improve that immunology portfolio and really focus on that. I need to see how Rinvoq and Skyrizi do at replacing Humira and how fast the Humira revenue declines. But I do believe in Abbvie. I just think there's a really big degree of uncertainty here. Of course, management may not be as committed to this, as committed to upholding the dividend as we would like them to be. If the stock price was to decline by half, for example, as is not unthinkable as we're likely going into a recession, although at the minute it seems Abbvie is immune to the market's ups and downs, then that dividend yield will be 7%. Then you would be looking at possibly cutting the dividend. But right now, at 3.5%, I think this is thoroughly sustainable going forward. Even if the payout ratio is a bit high at 76%, I think they can manage this going forward. And I think it is a big enough priority for management that they're okay with it. As far as the pricing is concerned, there's a decent margin of safety here based on relatively conservative estimations that I've made for a fair value of $168 versus today's stock price of $152. Don't get me wrong, I think there's a lot of uncertainty around this stock and I won't be buying right now because I want to see how Rinvoq and Skyrizi do over the longer term, and if Humira just rolls over and dies, or if it continues to produce strong revenues even if they're declining slightly and eventually they get overtook by Skyrizi and Rinvoq. But I think it's a great company that has produced excellent returns. I'm very happy to be proved wrong on this. I think the dividend is going to be relatively safe over the medium to long term. But again, this is just my opinion, and you should not take it as financial advice. You should do your own research and due diligence and make your own financial decisions. With that, I'll bid you goodbye. Please like and subscribe to the video if you're enjoying the content. I'll see you later.